Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis welcoming you to my podcast Money Talk for Wednesday the 5th of June. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. This morning, the podcast is extended to 1 hour, as in the second half of the show, I'll be talking with Dr. John Greenwood, Chief Economist at International Monetary Monitor, who's known as the father of the Hong Kong dollar peg, after an article he wrote in 1983 provided the basis for the government's policy to link the local currency to the US dollar. Before that, I'm going to discuss the latest business and finance news with Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, and John Beirne, Vice Chair of Research at the Asian Development Bank Institute in Tokyo. In today's business and finance headlines, Australia's central bank held its official cash rate steady at 4.1% in a closely watched decision Tuesday. Economists were split on expectations ahead of the decision. RBA Governor Philip Lowe said in a post-meeting statement, inflation is still too high and will remain so for some time yet. South Korea's inflation rate slowed for a fifth straight month to rise 2.7% year-on-year in June. That's the lowest since October 2021. This was a slowdown from the 3.3% recorded in May. And on a monthly basis, prices were flat in June after seeing a 0.3% increase in the prior month. The Wall Street Journal is reporting that the Biden administration is preparing to restrict Chinese companies' access to US cloud computing services, in a move that could further strain relations between the world's economic superpowers. The new rule, if adopted, would likely require US cloud service providers such as Amazon and Microsoft to seek US government's permission before they provide cloud computing services to Chinese customers that use artificial intelligence chips. Facebook owner Meta is launching its new app to rival Twitter and says it will go live tomorrow. The app, which is called Threads, will be linked to Instagram. Meta describes Threads as a text-based conversation app, and it's understood that Meta Threads will be a free service and there'll be no restrictions on how many posts a user can see. If you want to get in touch with any questions or comments on the show, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US markets were closed yesterday for the Independence Day holiday. Asian markets were mixed on Tuesday. Australia's ASX 200 rose 0.5% after the Reserve Bank of Australia left interest rates on hold. In Japan, the Nikkei 225 retreated from a new 33-year high recorded on Monday, falling 1%. South Korea's Kospi fell 0.4%. In India, both the BSE Sensex and the NSE Nifty 50 closed at record highs for the fourth straight session. The Nifty 50 ended the day with gains of 0.33%, taking its rally for the year to over 7%. Chinese markets were higher. Hong Kong's Hang Seng Index climbed 109 points, or 0.6%, to 19,416, led by energy and industrial stocks. The Hang Seng Tech Index rose 0.5%. It was hobbled by SenseTime, which tumbled 8.7%. On the mainland, the Shanghai Composite edged up just 1 point to 3,245. Shares of Chinese germanium producers soared on Tuesday after China restricted the exports of two key metals to the manufacturing of semiconductors. Yunnan Linkan Jinwan germanium surged by the 10% limit in Shenzhen, while Yunnan Qihong zinc and germanium paired early gains of 10% but was still over 6% higher in Shanghai. Futures markets are pointing lower this morning for Hong Kong and Japanese markets at the open. The Hang Seng is expected to fall around 70 points. That's 1/3% when trading gets going this morning. In the oil markets, Brent crude oil added 1.5% to trade at $76.12 per barrel after Saudi Arabia and Russia said they would extend or make voluntary cuts to output in August. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our guests on this Wednesday morning. We have with us Mark Michelson, who is chairman of the Asia CEO Forum at IMA Asia. Morning, Mark.
Good morning, Peter. Morning, John.
And over in Tokyo,
morning, Mark.
We have John Beirne, who's Vice Chair of Research at the Asian Development Bank of Institutes. Morning, John.
Morning, Peter. Hi, Mark.
Let's start having a look at some of the central banks around the region. First of all, in Australia, the Reserve Bank of Australia left its official cash rate steady at 4.1% in a closely watched decision Tuesday. Economists were split on expectations ahead of the decision, with 16 out of 31 respondents surveyed by Reuters forecasting a hike of 25 basis points and 15 expecting the central bank to hold. RBA Governor Philip Lowe said in a post-meeting statement inflation is still too high and will remain so for some time yet. So Mark and John, not really much comfort there, was it? It was quite a hawkish pause after two surprise increases in the last meetings, but it sounds like the RBA is still not comfortable, still going to see some more interest rate rises in Australia.
Yeah, we're worried about, and Australia's worried about inflation. So I think hikes are possible, easing is unlikely, and this is going to continue at least for a little while. It looks like that at this point.
Yeah, what I would say is that, there's still significant uncertainty ahead. I think, many central banks in the region are still worried about the hard landing scenario. And that may explain why we have seen a pause at the current juncture in Australia and some other central banks as well. So although inflation remains a concern, tightening rates further is also a significant worry.
So what would be the worst policy mistake then out of the two? They don't raise rates and then inflation takes off again and has another surge, or they do raise rates and drive the economy into a recession? What would be the worst?
Well, from my perspective, I think, the big concern for central banks at the moment is credibility. Mm-hmm. So I think that if we look at the ECB, the Fed, and the major advanced economy central banks, this has been a concern recently, with some mixed, views on whether rates should continue to tighten, given the inflation outlook and the recession scenario. I think that, central banks, they don't want to cause a hard landing in the economy, of course. But at the same time, they want to maintain credibility as regards their price stability mandate. Of course, the purpose of tightening rates is to achieve a sustainable level of inflation over the medium term and to anchor inflation expectations, not to trigger a hard landing. So I think they're exercising some caution at the moment to find some balance, but it's very difficult, of course.
And Australia, of course, has been under pressure, hasn't it, over the credibility, because people have been criticising it for being too late in raising rates.
Yeah, and that's the problem. It's become very political, not only in Australia, but you think in the U.S., it's part of the presidential campaign now. Real pressure on not to raise rates from some of the presidential candidates who don't seem as worried about inflation, although they use it as a major campaign issue. So it's very confusing. And as John said, it's credibility that really is important for everyone concerned, not only central banks, I think.
The problem is for Australia and most of the other central banks around the world, meeting their inflation mandate is also dependent upon the job markets, isn't it? Because most job markets seem very tight. Despite slowing economies, despite rising inflation, workers have seen their real wages decline over the past few years. So they're almost like demanding payback now. Then they're not going to come out of sort of semi-retirement or whatever it is they're doing unless they get better wages. That seems to be the problem, doesn't it? There's this expectation now that because inflation is higher, wages are going to have to go up as well.
We just did a session on return to work, managing return to work, and that was exactly one of the issues, especially among the younger staff members, younger employees, who feel that they want more better work-life balance, but also higher salaries, at least recognition of what they do, and the pressure is strong. And companies have to try to balance that because they need the people. But at the same time, they've got to try to make money as well.
Exactly. I fully agree. I think that the jobs market data is crucial in terms of understanding interest rate decisions and monetary policy decisions by central banks. But I think that, that's why it's really crucial to anchor inflation expectations, because that is really the target that central banks are looking at. We're not talking about inflation now. We're talking about inflation over the horizon, over the medium-term horizon. And it's important to anchor that, and that will feed into discussions about wages. So, as I said earlier, the issue of credibility is crucially important at this juncture, particularly this year. Many central banks are, of course, moving towards their inflation target slowly. By the end of 2024, they're talking about getting closer to that 2% into 2020 for many of the central banks. But it will be important for credibility in that assessment to be, transmitted to the wider economy, and that will feed into wage negotiations. And that's the challenge that all central banks are facing at the moment, some more than others, of course.
There has been talk, hasn't there, in some places about actually central banks having to think again about this 2% inflation target, that maybe it's going to be so tough to achieve without causing some grave pain to the economy, that maybe we've got to live with higher inflation. What do you think about that? Do you think that's a good idea? Do you think that's something that's going to be pretty disastrous for the economy?
Well, maybe I could say that I think that there's nothing scientific about the 2% level, of course. This was something that was introduced, I think, by New Zealand many, many years ago, at the start of the 90s or something like that. And, I think this is a level which has been communicated very clearly to the public and so on. And I think it would be difficult to just change the target, because it would create some confusion amongst markets, and it would also possibly detrimentally affect inflation expectations over the horizon, because, of course, all central banks that are inflation targeters are essentially tied into this 2% target, and it would require a large degree of coordination across the globe to change. I mean, I don't think it would be good for different targets to be in place in different central banks all over the world. I think it would be difficult communication.
Mm-hmm.
Yeah, it's become a mantra, right? The 2% for a lot of banks. But as it's been pointed out by several analysts, by several people who suffer, there's a lot of difference between 2% and 4% inflation for people on the ground. And they feel it pretty strongly. And you've seen numbers along those. And obviously, politically, that doesn't play very well either. So, again, a tough balance. And again, as John said, credibility is a good part of it. And actually, most of the decision makers don't have much around the world at this point.
I don't think people realise just over a fairly short period of time just what a difference to their purchasing power inflation of 2% means compared to 4%. If you put it into a spreadsheet, if you had 2% inflation every year for the next 10 years, your purchasing power will be reduced by 22%. If it was 4% every year for the next 10 years, your purchasing power will be reduced by 48%, almost halved. That's quite a substantial difference, isn't it? And I'm not sure people realise that is a cost they would have to pay.
It makes a difference, but I think even if people don't realise the exact numbers, they feel it, right, to some extent or another.
Mm.
Yeah.
Well, let me ask you a couple of specific banks, central banks in the region, where they all fit in with this. First of all, in Japan, Tokyo inflation data that came out last week, 3.1% year on year in June. So it's above the Bank of Japan's target. So where does the Bank of Japan fit in the credibility stakes at the moment? Yes,
well, I mean, inflation has been above target in Japan for quite some time now. As you said, 3.1% year on year. And that's the headline rate. There's also some pressure on the core, the underlying rate, which is also above target. There are still large degrees of uncertainty on whether this level of inflation is sustainable. So over the medium-term horizon, it's still the consensus that inflation expectations are around the 2% level, and that's why there's been no change in monetary policy in Japan. Of course, related to that is going to be close monitoring of wage developments in Japan, particularly the extent to which small and medium-sized enterprises will increase wages and have the capacity to do so. And that may trigger some inflationary pressure over the course of the next 12 months. But at the moment, it still remains the case that even though we see this 3.1%, above 2%, of course, targets, monetary policy is not expected to change.
And what about up in the mainland? The PBOC, it's got a new party, Communist Party chief, Pan Gong-shen. He's been appointed to the role of Communist Party chief at the bank. He's replacing Guo Shuqing, and he's also going to be in line for the next governor. What does this mean? Is this China really sending out a signal that it wants stability? Because it's got someone there who's got quite a lot of experience in commercial banking. Is that the number one aim here?
I think it's part of it for sure, and also his international experience, right? He studied at international university. He knows the international community, like the current governor of the PBOC, and therefore would, I think, send a little bit more confidence in the market. That's a really important position, not only for China, but I think for the rest of the world as well.
Yeah, exactly. I think at the start of this year there was a lot of talk globally that the reopening of China would stimulate a huge boost to global growth, but of course that has tapered off a little bit in recent months. There's been also talk about the impact of monetary easing in China not having the desired effect, but I don't think there's a great surprise there in my perspective, because the pass-through of interest rate decisions to the wider economy will take some time. So we're not going to see rapid responses in the real economy for some time in China. It's only just opened up. So I think that needs to be borne in mind. And that would be one of the challenges faced by the new governor, the new chief of the PBOC, to really, get the economy back on track in terms of the transmission of monetary policy to the real economy.
Now, Richard Koo, who's chief economist at the Nomura Research Institute, he says China's in a balance sheet recession. He was the one who first used that phrase, invented that phrase, to describe Japan, actually, back in the 1990s when it sort of descended into stagnation. Basically, a balance sheet recession occurs when households and businesses divert more of their income towards paying down debt rather than consuming or investing. So what's the solution to that?
Well, I think that, whether it's in a balance sheet recession or not, it's difficult to really, say for sure. I mean, it would involve really looking closely at the data. But what is clear is that consumption has not kicked off as a result of the monetary easing that we've seen in recent months, nor investment, despite expectations to that effect at the start of the year. So what would be the solution? Households and firms in China have, significant debt repayment obligations. So this is just something that needs to be, dealt with. Of course, the economy, in terms of policy decisions, can help with that on the monetary policy side as well as on the fiscal policy side. But I think that, in order to, avert this balance sheet recession scenario, it would be important for monetary policy transmission to be improved. I think that would be very important in the current context. And as I said, in the case of China, it's just coming out of this period of lockdown. So it's still in a transition phase, I think, in terms of re-entering the global economy in a sort of more fluid manner.
Yeah, I think this is another example of long COVID. Again, not the medical side so much, but the economic side. And of course, I remember Richard Koo with his balance sheet recession around 1990 or so about Japan. He's mentioned fiscal policy, fiscal stimulus as being part of it, but he also has said, and I don't know if this even works, but the government providing households and businesses with some income that they can help repair their business balance sheets and give them enough confidence to start borrowing again. Obviously, something has to happen along these lines. I think easier said than done, but it's going to be an issue going forward for quite a while, I think.
Let me ask you finally about one other quasi-central bank in the region. Here in Hong Kong, the Hong Kong Monetary Authority, of course, we have no choice. We're pegged to the US dollar, so therefore we import the US's monetary policy. Is that sustainable, do you think? Because it's putting more strain, isn't it, on the Hong Kong economy at the moment. We don't really need these high sort of interest rates at 5%. And if they go up even higher, closer to 6%, isn't that going to cause some problems for the Hong Kong economy?
Certainly, I think it's a big problem. You know, the Hong Kong Monetary Authority has been purchasing domestic currency in order to maintain the peg, of course. And, you know, whether this is a sustainable situation is, you know, something that's very difficult to assess. I think it's obviously not something that can carry on over the longer term because markets would intervene and, you know, engage in further carry trade type positions, which would, you know, really test the credibility of that peg severely. I think that, you know, in the case of Hong Kong and other economies, I must say, everything is really driven by what's happening in the US. The strong dollar over the course of the past year has been impacting some economies more than others. And in the case of Hong Kong, of course, it's much more stringent because of the peg that's in place, the currency board. So I think that it will be difficult to maintain that in my perspective. But on the other hand, you know, should the peg break, it would also have significant detrimental consequences in terms of capital outflows, for example, and things of that nature.
Look, it can always break, and this has been an issue for a long time. I had John Greenwood, who you're going to have on in a few minutes, and Mark Faber, Dr. Dumont, around in the mid-1980s, talking about the same issue in many ways. The peg has worked pretty well. It may not work forever, but it's come through global economic and financial shocks, and with it being able to have some credibility. It's political as well as economic. So our high interest rates and economic volatility, is it a price we need to pay for international confidence and eliminating foreign exchange risk in Hong Kong? And can that continue? I think it is for now, and it certainly if it was changed, it would affect the internationalization of the yuan and other issues as well. So I suspect that's here for a while. I may be wrong, I may be proved wrong, but I think it still performs the functions that it was intended to perform when John Greenwood first wrote that article in 1983.
Well, we'll hear from him.
I fully agree with you, Mark. I would say, though, you know, what's specific to the current environment is the strength of the dollar. So, you know, if we go back, let's say, 40 years, for example. So we had the Plaza when the dollar was just before the Plaza Accord, when the dollar was at its highest level. We did not see a strength in the dollar from that period until the period right before 9/11. And now we're at the highest level since the period right before 9/11. So there are only 3 episodes of this extreme level of dollar strength. And this is the exact type of test which would be problematic in the case of a peg to the dollar. And that's why we're seeing the problems at the moment. So if the dollar would depreciate, for example, if inflationary pressure would dissipate in the US and the dollar would start to come down, then we would see some easing in this pressure on Hong Kong as regards the peg. But, you know, as we are aware, inflation is remaining sticky in the US. And that's why, you know, the outlook is still for a monetary policy tightening stance at the global level. And you know, it's very uncertain as to whether this dollar strength will dissipate in the near future.
Yeah, I agree. This is a new challenge. I just think at this point, and again, it could change very quickly, alternatives are less attractive.
Well, we're going to hear very shortly from John Greenwood, who is the father of the Hong Kong dollar peg. He was the one who wrote that article back in 1983 that led to the currency board being established. We'll get his thoughts on what the future is for the Hong Kong dollar peg in the show very shortly. Before that, let's move on and talk about some of these trade issues. China's restricting exports of products and materials containing gallium and germanium, metals that are vital in semiconductors, 5G base stations and solar panels. I suspect, Mark, your members must be tearing their hair out at more and more restrictions, tit-for-tat restrictions. Presumably this is retaliation for the US and also its allies, because this affects Holland, it affects Japan, have also put restrictions on exports of semiconductors and manufacturing equipment to China.
There are a lot of contradictions, aren't there? Which is a phrase that's often used. And here, Secretary of Treasury Janet Yellen's arriving in Beijing tomorrow to try to deal with a lot of these issues, and she's coming at a time when certainly it's very important to talk about trade, about some of the issues you just raised, but the situation seems to be getting a little bit worse. You mentioned the China moves. The U.S. is about to, it looks like, put more restrictions also on trade in semiconductors and cloud computing and so on. And the U.S. is trying to ease the restrictions on Micron and other U.S. companies that are involved in this business. It's a very mixed up situation. I just hope, we all hope, that Secretary Yellen's visit and then perhaps subsequent visits by maybe the Secretary of Commerce and others may help at least move us to a more steady state, if not solve these problems. But with this volatility going on, with this tit for tat, it makes it much more difficult, I think.
Yes, I fully agree. And I think that, there are also what you could term as innocent bystanders to these types of restrictions between one economy and another. So trading partners to China and the US will also be affected negatively as a result of this. And, there are classic problems with the impacts of trade frictions abroad, and it leads to inefficiencies in supply chains and, also inefficiencies in pricing. So hopefully, these factors will be ironed out, and, we need to move to more sort of an order in terms of trade and removing these types of restrictions over the medium term, at least.
Other than that, no worries, Peter.
Yeah. Well, I was gonna say, just to put this in perspective, China is the world's largest producer of the two elements. More than 95% of the global gallium output and 67% of germanium production comes from China. The only thing I would add to that, though, is that although China is the world's largest miner of these two elements, it's nowhere near that in terms of processing it. In fact, Japan, doesn't it, has a big part to say in the processing of gallium and germanium. So I presume this impacts Japan as well.
Yes, as I sort of alluded to, it affects many economies, and in this case, it affects Japan, of course. But I think, more broadly, it's important to have a well-diversified sort of a system of global value chains. And actually, it's something that hopefully that we are learning from the episode last year and the pandemic, of course, is to make our supply chains in the Asian region and even globally much more diversified. So we're not impacted so much on a specific shock in a specific country. I think that's very important, and it's one of the aspects that the G7 and the G20 are trying to push forward. Called de-risking, let's say. So in order to diversify supply in energy, supply in the supply of different raw materials that are necessary for production of, any type of manufactured output. So I think, many economies are affected by this, of course, but de-risking would be the important aspect here, and diversification along the supply chain.
This is one of the top subjects of every conversation we have among executives. Obviously, they're all trying to do that, almost all. But the problem is with mixed success as you try to move part of it to Southeast Asia or to Mexico or to Eastern Europe. You can make some progress, but China has certain advantages that are difficult to replicate in some places. And over time, that'll happen. But in the short term, especially for some companies, it's become very difficult to do in practice.
Presumably this is a double-edged sword, isn't it? Because if China does go ahead with this, of course it will drive up prices for those metals. So then it makes it more feasible for other countries to also mine, because these can be mined in other countries like the US. They just choose not to do it at the moment. So presumably it will prompt other countries like the US to start up their own mining facilities for these types of metals and diversify away from China. It will just accelerate that process of de-risking, won't it?
Yes, absolutely. And it will also affect the pricing as well, because it would increase the supply. So I think, if one is interested in having a well-diversified supply chain and making your economy less vulnerable to specific shocks, then this would be a good outcome, I would say.
The issue, just to finally, one of the issues is that, you think of the U.S. trying to do this, and of course they're trying to do this in many ways, but so is China, as the restrictions come on China, and China obviously has the wherewithal to be able to do this more quickly and more effectively than many other nations around the world, and so that might be a problem as well as countries try to move in that direction.
Well, thank you both very much. Very interesting discussion this morning. We'd love to carry on longer. That was Mark Michelson, who is chairman of the Asia CEO Forum at IMA Asia, and John Beirne, who's vice chair of research at the Asian Development Bank Institute over in Tokyo.
Peter Lewis's Money Talk.
This is Peter Lewis's Money Talk, and I'm pleased to welcome now to the show Dr. John Greenwood, Chief Economist at International Monetary Monitor, who is known as the father of the Hong Kong dollar peg after an article he wrote in 1983 provided the basis for the government's policy to link the local currency to the US dollar. He still sits on the HKMA Currency Board subcommittee, which monitors and reports on the linked exchange rate system that pegs the Hong Kong dollar against the US dollar between a range of 7.75 to 7.85. Good morning, Dr. Greenwood, and thanks for joining me this morning.
Good morning. It's good to be here.
Thank you. It's hard to believe, isn't it, 40 years ago now that you first wrote that paper where you envisaged a currency board system for Hong Kong. And the arrangement that you described at the time, it was designed to stand the test of time and provide stability for Hong Kong through all sorts of tests and upheavals. Did you really imagine that that time it would still be intact 40 years later, almost exactly as you proposed it?
Well, it has been strengthened to a good degree in the interim. So several measures have been taken to strengthen it. But yes, I did envisage that it would last a long time. And I was criticized quite a lot at the time because at the time most countries had moved towards floating, and moving towards a fix was completely contrary to the trends in the world at the time. And so I got a fair amount of criticism, but my conviction came from the fact that basically the system is based on an idea like the gold standard. That is, that if you fix the price of the currency as opposed to the deposits in a banking system to the price of gold, that will, there's no reason why that shouldn't last for many, many decades. And that the gold standard, the silver standard that Hong Kong had, indeed did last for many, many decades. And all we did in 1983 was to use the US dollar instead of silver.
So is it 40 years later, is it time to make some changes to the system now, or is it still working just as well as it was, just as relevant as it was 40 years ago?
I don't think it's time to make any major changes. People forget that it was introduced not for political reasons. Remember, it was a time when Britain was negotiating with China over the future of Hong Kong. Margaret Thatcher had been to China. That was followed by a capital outflow from Hong Kong and so on. And people thought, well, this is a political solution. Once all that's solved, we can go back to normal. But actually there was a fundamental economic flaw, a financial flaw, if you like, at the heart of the system. At the time, the Hong Kong government, or there was no Hong Kong Monetary Authority, and the monetary agency within the finance branch was not able to control either the quantity of money in Hong Kong or the price. Now, you have to do one of those two things to have a stable system. And essentially, fixing the price solved that problem.
It's brought a stability to, if you like, the price of money. I mean, many people decried at the time when Britain and the United States moved off the gold standard. They saw that as a step backwards. So we've had this stability here, but our economic circumstances have changed very considerably, haven't they, since 1983? And some people say that having a peg to the US dollar is holding back now Hong Kong's economy, because we're effectively importing US monetary policy that isn't appropriate anymore for Hong Kong today in 2023. What do you say to that?
Well, I say that the really important thing is that Hong Kong's economic activity is driven by global economic activity, not just by China. And since it is still the US which is the dominant force in driving global economic activity, it's perfectly satisfactory to be pegged to the US dollar. In fact, better, because in many respects, because the US dollar is such an important currency for trade transactions, for investment transactions, and of course it's held very widely as an international reserve currency. So for all those reasons, the system as it's set up is very suitable for Hong Kong, which wants to be an international financial center, if you like, a kind of representative of the New York money markets in Asia.
So do we have to start thinking about, though, the economic costs of the peg, because we've got US interest rates at 5%, they could go up to 6%, maybe, heaven forbid, even higher. It's quite possible, which could do a lot of damage to the local property markets, to Hong Kong's economy, to the stock market. Do we have to look and say we also need to take into account now there are economic costs to having the peg and having that discussion?
Well, it's a matter of alternatives, really. I mean, if you didn't have the peg, the question is what would you replace it with? Pegging to another currency might seem to be a solution, but again, it's better to be pegged to the currency that is the dominant currency for global transactions, and certainly all the developed economies, and prior to that, the emerging economies, most of them have seen interest rates rise. China, in that sense, is a bit of an exception currently. So pegging to the US dollar is still an appropriate thing to do for Hong Kong. It's certainly not appropriate to go back to a floating exchange rate, which would make Hong Kong very vulnerable in any political crisis. And pegging to other currencies probably wouldn't make a great deal of difference, I don't think. So it's probably best to choose the dollar.
What about pegging to the yuan? Or some people say not having a currency at all, adopting the yuan at some point altogether instead of Hong Kong having its own currency.
Well, let's take those in order. Pegging to the yuan itself is feasible, technically feasible, but the problem with the yuan is that it, as everybody knows, it's subject to foreign exchange control, capital controls. And what that means for Hong Kong is that the automatic adjustment mechanism wouldn't work as well. Now, by that I mean the ability to arbitrage not just money market rates, but prices of goods and services and property and so on. All of those things continuously adjust to the prices of similar things in the current currency to which the Hong Kong dollar is pegged. And if there is a barrier there due to foreign exchange controls or capital controls, then that's not going to work so well. It's technically it's something you can overcome, but it's not ideal. The second part of your question is, what about adopting the renminbi instead of the Hong Kong dollar? Well, there's a couple of objections to that. One is that, first of all, the basic law says that the currency of Hong Kong shall be the Hong Kong dollar. So unless Beijing and the Hong Kong authorities are prepared to ride roughshod over, I think it's Article 111 of the basic law, then we're going to have the Hong Kong dollar certainly up until 2047. The second thing about it is that if you adopt the yuan, you can't really have a yuan that is subject to different regulations operating in Hong Kong from what's happening in the mainland. And that would create a major leakage out of China, and they would not favor that, I don't think.
But the peg isn't going to break or be forced to break because of the way that it's designed. It's it's not a traditional peg. It's a currency board, and it operates very well by sort of ironing out the fluctuations. But presumably at some point, Hong Kong and China are going to have to consider voluntarily moving towards a yuan-based system, and maybe at some point in the future, who knows, it may not be that far away, to start thinking about what are the circumstances under which that could happen and how it would happen. Do you see that as almost being an inevitable discussion now?
Not really. You're right that the currency board mechanism is the strongest form of fixed exchange rate in the world today. No currency board that is a genuine currency board has ever been broken. Now, people cite Argentina, but that wasn't a currency board, and they broke all the rules. So that's not a relevant comparator, or not a relevant currency to compare with. The broader point, I suppose, is that if you have that there are distinct advantages both to China and to Hong Kong in having a currency which is open to the world and accessible to the world. Obviously also for Hong Kong people, they are free from foreign exchange controls, and businesses here can freely transact in any currency of the world they like from Hong Kong. Now those are positive advantages which do not occur currently in China. So unless you're going to sort of ditch the one country, two systems idea and the Hong Kong dollar along with it, which would mean that Hong Kong would effectively be part of China in terms of its economic rules and regulations, then I really don't think that adoption of the yuan is a good idea.
The one thing that maybe is different, I'm wondering, this time from previous periods, where we have seen some stress, but the currency board nevertheless has worked as it should, is the strength of the US dollar. We're in this period now where the US dollar is very strong, and as long as US interest rates are going to keep on moving up, it could carry on this sort of strength and getting stronger as well. That's sort of putting some strains now, isn't it, on the peg and the currency board?
It doesn't put strains on the peg itself or on the currency board mechanism. The currency board mechanism will operate no matter what the level of the US dollar and no matter what the level of the Hong Kong dollar is relative to the US dollar. As long as there are ample reserves and the convertibility undertakings, those 775, 785 limits, as soon as they are reached, provided that the authority has the ability to either provide Hong Kong dollars or withdraw Hong Kong dollars on demand from the market. And that's a key point to stress. It's not the Hong Kong Monetary Authority intervening so much as the banks going to the HKMA when the market rate exceeds those limits. So let me just illustrate that. So if the rate was on the weak side and it fell to, say, 786, at that point it would be cheaper for banks on behalf of their customers to buy US dollars at 785 from the authority rather than in the market at 786. So the demand is coming from the banks on behalf of their customers. It's not the HKMA sort of stepping in. Technically, you could say they're one and the same thing, but I want to make that point. So, what that stresses, or that emphasizes, is that there is no stress or strain. There's always the ability to fulfill those convertibility undertakings at the 775, 785 ranges.
Are the tensions between the US and China going to become a factor in this? We've got seeing export controls, we're seeing more and more sanctions by both sides, which is sort of restricting trade, disrupting supply chains. There is a worry, and the IMF and the World Bank have both expressed that worry, that the global economy is going to fragment into sort of two competing economic and trading blocks. If that happens, Hong Kong is going to be put in quite a vulnerable position, isn't it? Because we've got an economy that's obviously dependent upon mainland China in many ways, but a monetary policy that's tied to the US. And then in the extreme, Hong Kong could be held hostage to financial sanctions from the US and the West. Could the peg survive that type of extreme scenario?
the peg could survive, but it would be very bad for the Hong Kong economy. We have had that kind of scenario, or even more than a scenario, suggestion before. During the Trump administration, there was a threat that Hong Kong might be subject to, exclusion from SWIFT exchanges between banks. That's the messaging system which is used to underpin global foreign exchange markets. So it's not unknown, but the damage that would be done would be especially to all foreign banks operating here. So it wouldn't just catch Chinese banks in Hong Kong or Hong Kong-based banks, of which there are only a few now, but all the American banks, the European banks, the Middle Eastern banks, and so on that all operate here would all lose out. So I think it's unlikely. So in that particular case, during the Trump administration, it was argued that there would be too much damage and loss to American interests, and so the proposal was shelved.
One of the things that's changing very much for the global economy is we're now living in, certainly in the western part of the world, high inflation economies, inflation at rates that we haven't seen maybe in 4 decades, certainly in the UK, in Europe, and in the US, not so much out here in the mainland. So we've got to get used to this era of low for long is over for now. It's really changed, hasn't it, the way in which our economy is working. But how did we end up in this position where...
Well, don't exaggerate the position. This is an episode of inflation. We are not entering an era of higher inflation.
So you don't think this is a lasting change
No.
of higher inflation for a long period of time?
On the contrary, we have high inflation only because major central banks around the world made mistakes during the COVID period. They engaged in very aggressive QE operations, which increased the quantity of money very rapidly in the US, the UK, the Eurozone, Canada, Australia, New Zealand, and a number of other countries. But some did not do that. China didn't do it, Switzerland didn't do it. But the inflation from that increase in the stock of money is now coming to an end, and monetary policies have been tightened so aggressively that in some countries like the US, the amount of money, the quantity of money is falling, which means that the risk now is not of inflation but of deflation. So I think that US inflation will come down, well, it's already come down quite sharply, and next year and the year after, there's a significant risk not only that we have zero inflation, but it could even go negative. So don't exaggerate. We're not in a permanently higher inflation era. I mean, Japan is a good illustration of that. Japan, for the first time in 30 years, has an inflation rate of more than their target of 2%. But again, that's only because of what they did during the COVID period. In that case, it was lending to the banks, not QQE or YCC. But that is now over. And money growth, which is what really matters, has returned to a rate which is below what it was during the COVID period. It's comparable with what it was pre-COVID. In other words, Japan is most likely to go back to a low inflation, low interest rate environment, just as it was pre-COVID.
So what you're really saying is that these central banks, they've actually got on top of inflation. We're going to see inflation coming down, and therefore you would say, as well as that, interest rates have peaked and interest rates are going to start to come down as well?
I wouldn't give them too much credit for that. They created the inflation in the first place.
By not focusing on money supply.
Correct. And they've sought to deflect the blame onto all these, what they call accidents, these sort of unforeseen events like chip shortages or energy prices going up or the invasion of Ukraine causing food and fertilizer shortages and so on. I mean, anything they can to defer the blame. But the reality is that inflation comes only from an excess quantity of money, and it's the central banks that created that, mostly by doing QE.
So presumably that's why then in places like China, which didn't engage in QE, didn't provide handouts for households and consumers, that's why their inflation is virtually zero compared to what we're seeing in places like the UK and the US. It's linked to whether or not how they responded to COVID and the type of QE, whether or not they engaged in that. Because that's where seems to be the main differential, doesn't it, between, say, Japan and China and the West.
Yes, but you've got to be careful. You said handouts, not just QE, but also you said handouts to families and firms. That could have been done by borrowing in the markets. That was not necessarily inflationary. So the US fiscal policy, the UK fiscal policy was very generous, and it increased government debt substantially. But most of that was borrowed in the markets. There was a separate decision by the independent central banks to create money. That's the important part of the inflation story. The fiscal part is far less important.
But isn't the problem now, though, that having done that, one of the issues is real wages for workers have fallen quite substantially during this inflation episode. So would you not expect that those wage earners are going to want to try and catch up, at least while the labour markets are very tight? So that's going to create a sort of a permanently higher expectation of inflation.
No. It's perfectly legitimate for people to want to replace lost real wages. That is, because their prices have gone up, their real wages have weakened. So they can demand higher wages, and you would expect them to. But who's going to pay that? The firms have got to pay that, for the most part, and the firms won't have the money if money is being squeezed. So pushing for higher wages is not self-sustaining. Unless the money is there, the higher wages can't be paid, and the expectations on their own don't create higher inflation. You've got to have faster money growth to support higher inflation.
It's a sort of spiral, though, isn't it? The companies then will pass on those higher costs to consumers, of course, also the workers as well. So it sort of becomes a self-reinforcing philosophy.
No, they won't. As I said, a number of countries, notably the US and the UK, now have negative rates of money growth, and also the euro area. And that means that spending will be curtailed, revenue growth will gradually decline and may even weaken, may even go into negative territory. Profits will decline, and therefore the firms won't have the ability to pay those higher wages. So we are much more likely, in my view, to see layoffs, an increase in the unemployment rate, rather than a continuation of of what is called a wage price spiral. But in reality, a wage price spiral is only feasible when the central bank and the banks together are creating a lot of money.
The extreme where it seems to have gone horribly wrong is probably the UK, isn't it? Where now it's interesting that, policymakers are almost blaming each other. The government and the Bank of England are squabbling over who's responsible for this. Banks are being blamed. Supermarkets are being blamed. There seems to be a big blame game going on now as to why has this happened, and as consumers and workers start to realise just what the cost is to them of this high inflation.
Well, as I said earlier, the inflation was created by the central banks, and in the UK case it was created in Threadneedle Street, and Andrew Bailey and his Monetary Policy Committee have done everything they can to try to deflect the blame elsewhere. And you're right, there is this blame game going on. But the reason why the UK inflation rate seems to be a bit more sticky is, first of all, the government has intervened in the energy market in a way which has slowed up the increase of energy prices, but is now holding them higher than they would otherwise be, number one. And number two, by squeezing the public sector over the past decade, they're now facing an avalanche of demands for catch-up. And it's mainly public sector wage demands that are fueling this concern among politicians. But again, it's not going to exacerbate the inflation rate unless the Bank of England accommodates higher prices with more money. And currently that is not happening.
Can central banks reach their 2% inflation target, or do you think there's going to have to be some discussion about revising those targets? Because there has been some talk already, hasn't there, in the US about whether this 2% inflation target is still appropriate. What do you think about that? Do you think they can be reached? And if not, do they need to think about revising those targets upwards?
Yes, they can be reached. Most of the last decade pre-COVID, from 2010 to 2019, the US was very successful in steering a course that produced almost exactly 2% on average consumer price increases. And as I've said, US money growth has slowed very dramatically from the COVID days, and the risk at the moment is that they will undershoot the 2% target. And the same is true for other countries. Now, of course, it's not going to happen tomorrow. It takes about 2 years for changes in money growth to feed through to inflation. And most politicians and financial commentators are too impatient to wait that length of time for those effects to come through. But come through they will. As I say, at the moment, the signs are, with these very low rates of money growth because of the abrupt rise in rates, that if anything, we're more likely to undershoot the 2% rather than to overshoot it. But 2% is perfectly feasible, and I think is probably a reasonable rate. The reason it was set at 2% in most cases is that central banks wanted, in the event of a recession, to have some margin for cutting rates, because if the target was set at 0, then interest rates generally would be rather lower, and they wouldn't have room to cut if a recession came along.
It's interesting what you say, because there's quite a clear divide between what you are saying and what the solution is to this, to maybe what some other people are saying, and even organisations like the IMF, who are talking about a world now of structurally higher inflation, and in particular because the retirement of the baby boomers means, you've got Labour is able to press its claims, if you like, on national income more aggressively. So the IMF is sort of saying that, Eurozone firms have passed on this higher input costs to consumers. Now, you're saying that this is ultimately down to money supply, that's the reason why we have this higher inflation. It's not structurally, it's not a structural issue at all, and it's something that can be addressed.
You're absolutely right that I am not part of the consensus. I am one of the relatively few people nowadays who believes, and this is based on the evidence.
Sound money.
Believes that inflation is ultimately a monetary phenomenon. And writing and following Asian economies, writing about Asian economies and following them for 40 years as I did, based here in Hong Kong and in Japan, that was very, very clear to me. Now, just like the laws of gravity don't change, the laws of economics don't change. And just because we have an economics profession which doesn't believe or doesn't monitor money anymore, it doesn't mean that the underlying drivers of inflation have changed. The drivers are still the same. But you're right, people talk about all these other things which are alleged to have an influence on inflation, whether it's energy prices or aging of the population or wage price spirals or those are all basically narratives. They are stories about what is going on currently. And what's happening is that people are elevating what is really a symptom from the transmission mechanism of faster or slower money growth. They're translating that or elevating that symptom into a cause. But those are not really causes at all. They are results of the prior rapid growth of money.
Well, it's going to be very significant because if you're right, this is going to have a very significant impact on financial markets because ultimately it means interest rates have peaked, inflation is going to come down, and interest rates are going to come down maybe much higher, come down much lower than people are anticipating, and that terminal rate is going to be much lower as well. There's some very significant implications from this for you if, by not being part of the consensus, but turning out to be right.
Absolutely. But of course, timing is critical. So we have yet to go through that recession. It doesn't, just because one can envisage this sort of outcome, it doesn't mean that it's all going to happen tomorrow.
Let me ask you quickly before we finish about the mainland, because obviously the mainland economy is still growing, but it's disappointing people in that it's not growing as fast as people hoped when it came out of lockdown. Lots of people talking about stimulus, waiting for some sort of stimulus on the mainland, and we seem to be in this sort of what some people would call a balance sheet recession, where households and businesses now want to pay down debt, pay off their mortgage, rather than consume or invest. What is the solution to that?
Well, let me describe the problem first. China has learned its lesson from the big stimulus that they implemented in 2008, 9 and 10. Which, although it was called a fiscal stimulus, you remember after the time of the GFC, 4 trillion yuan, which at the time was about 6% of GDP. In fact, that was financed by the printing of money. Money growth went from 15% per annum to 30% per annum. That generated a doubling in the stock market, a huge increase in house prices. The economy strengthened, there was a worldwide commodity boom set off, and inflation went from negative to about 6 or 7%. So all the effects you would expect from faster money growth occurred. But then it also set off the surge in lending in the shadow banking business and the build-up of leverage. So China, I think, has learned its lesson. And so although there is talk about stimulus, I don't think they will want to repeat the mistake that they made then of doubling the rate of growth of money. That would be just another setback, and then they'd have to spend time to overcome that. So we're much more likely to see careful structural measures aimed at specific sectors rather than an across-the-board increase in credit or infrastructure spending. Curiously, China spent the rest of the decade of the after 2010, slowing money growth down. But at the same time, credit growth increased. Now, that's a very unusual combination. An increase in leverage at the same time that money growth was slowing and inflation was coming down. There are not many cases like that, but the US in the 1920s is one example. They had very low growth of money and very low inflation, but there was a leveraging up, which led to the 1929 disaster in the stock market, and then later the collapse of the economy as money was reduced even further. So I think that that there's some truth to the idea that China is in a balance sheet recession, as you mentioned, but the solution is to facilitate the deleveraging without increasing money. And again, there are ways to do that, but it would take too long to discuss now.
Well, I'd love to talk more with you. Thank you very much. It's been very fascinating to hear your thoughts on this, and thank you for coming in. That's Dr. John Greenwood, who is Chief Economist at International Monetary Monitor. Thank you for listening this morning. Just a reminder once again to take a look at my website, peterlewismoneytalk.substack.com, where you'll find my daily newsletter with a lot more business and finance news to go with this show. I'll be back tomorrow when my guest will be Andrew Ferris, the CEO of Economist Advisory, and Michelle Lam, Greater China Economist at Société Générale Corporate and Investment Banking. We're also going to take a look at how Hong Kong's mandatory provident funds have performed in the first half of the year with Francis Chung, Executive Chairman of NPF Ratings. So please catch me tomorrow.
Money Talk